Thank you for joining me for a very special edition of Hunting the Great Red Capital Gains Shark, where we're going to give you some solid math background in order to distinguish you from a hobby investor. So we're going to talk about return on equity, return on investment, cap rate, and true net cash flow. So make no mistake, real estate is absolutely a numbers game. If you do not know your math, you will make some mistakes. So this is useful for comparisons, contingency planning, buying and selling a property, financial and estate planning, what components that your real estate has and how it affects your life in general. If you don't know your math, well, garbage in, garbage out. So start off with return on equity. This is defined formally as your return on the asset minus your liability. With property owners, we're talking about debt service and any expenses or improvements. So this number can change over time if there's any deferred maintenance or any capital expenses that occur. That obviously impacts your return on equity. So you also have a changing fair market value component. So return on equity is typically factored once a year, if not once per decision. We'll say once per year for comparison of a portfolio. Now, your return on investment is what you actually put into the deal, not your return on equity. You buy your equity and it grows over time. Return on investment is your skin in the game. So if you have, if a seller has a cap rate, then your buyer is going to have a return on investment. Same calculation, same moving parts. We're just talking about it on different sides of the table. So it is the cost of the investment divided by the expected expense of the investment. And keep in mind that TIs or capital expenditures do affect your return on investment because you're effectively putting more money into the deal, which obviously you put more money in, that impacts proportionately your rate of return on the downside. So your cap rate. Cap rate is the quick and dirty. Most real estate investors kind of know cap rate. If you're dealing with a realtor that doesn't know cap rate and you're dealing with multi-unit properties or commercial properties, you need to find yourself a new realtor. Cap rate is absolutely the grassroots calculation for basic comparisons of property. And what it is you take your expected income and you divide it by your sales price. And that tells you roughly how much you're capitalized. So quick and dirty numbers, if we're dealing with a $100,000 property that generates $1,000 a month, that is $12,000 a year. $12,000 a year is 12% of $100,000. So that would be a 12% cap rate. If we add another zero, then we're talking about a $1 million property, right? Not 100,000, add an extra zero, a $1 million property generating $12,000 a year, your cap rate drops from 12% to 1.2%. So that is, obviously not as desirable. But when you're factoring for cap rates, that's your quick and dirty for finding your comparisons. What sort of income are you solving for? Because usually it's an income question when you're dealing with investment property. So, the big one, true net cash flow. If you even have a hint of what true net cash flow is, then you are quickly approaching the definition of a professional investor. Now, true net cash flow is actually what the property does for you. Now, there's lots of folks that say, well, it generates $1,000 per month, so I got $12,000 a year. That's my true net cash flow. No, you are absolutely 100% dead wrong. True net cash flow factors in your depreciation schedule, all of your capital improvements, and your after-tax net. So if you don't actually know what your property is doing, sorry, you're a hobby investor. This is what the professionals have to know, because this is the data that you have to have for a bona fide apples to apples comparison for multiple different types of asset classes. If you don't know your after-tax net, you're not even talking the same language. So when you have to transition out of real estate and you factor in all of your after-tax, all of your post-sale costs, then that's going to give you the apples to apples comparison data that you need to see if you're making money or losing money when you sell. So I realize this was a quick and dirty explanation of the math, but it's incredibly important that you at least have enough data that you can define a professional to assist you with your choices when it comes to real estate. So thank you very much for joining me for this special edition of Hunting the Great Red Capital Gain Shark, where we give you a little bit more into the idea of how to actually value things properly. So thank you very much. And any questions, please leave them in the comment section.